The world of trading is both exciting and demanding. Many people look for a secret formula to succeed in financial markets, but few realize that the real secret isn't about finding the perfect system. It's about understanding and applying key psychological principles. Mark Douglas, a major figure in trading psychology, shared 5 essential rules that have changed the lives of thousands of traders worldwide. Here's a fresh perspective on these rules, explaining what they really mean and how they can help you become a consistent and profitable trader. One of the most common mistakes beginners make is assuming that the market behaves in predictable patterns that repeat exactly the same way. In reality, every situation in the market is completely new. Even if you spot a familiar pattern or movement, the surrounding conditions are never identical. For example, if you see a chart setup that gave you a good profit in the past, it's tempting to think that trading it again will produce the same result. But things like trading volume, who else is participating, global economic conditions, and even your own emotional state at the time all make the situation unique. This habit of looking for patterns and relying on past experience is totally normal. It's how our brains work. We're wired to notice repetition and try to predict what happens next, which gives us a sense of control and safety. But in trading, this natural tendency can actually backfire, making us overconfident in predicting the future and blind to risks. A true trading professional understands that every moment in the market is unique and doesn't cling to past results. This mindset helps them stay objective and avoid getting caught up in unrealistic expectations or strong emotions. When you fully accept that each trade is independent from the last, you can break free from the cycle of frustration and self-doubt that traps so many traders. Another widespread belief among beginners is that to make money, you need to know for sure where the market is going. Because of this, many people spend their time searching for perfect signals, extra confirmations, or delay decisions out of fear of being wrong. But trading isn't about certainty, it's about managing probabilities. If you have a strategy that gives you a statistical edge, you know that over a group of trades, a certain percentage will work out and some won't. For example, if your method has a 60% win rate, that means out of every 10 trades, about 6 will be winners and 4 losers. What you can't know is the order in which those wins and losses will happen, or exactly how much each trade will make or lose. Thinking in terms of probabilities instead of certainties completely changes how you trade. Your goal isn't to be right every time, but to follow your trading plan with discipline and consistency. Losses stop feeling like failures, and wins don't feed your ego. Each result is just one small part of a much bigger picture. Problems arise when you trade with fixed expectations, hoping the market will behave exactly as you want. When it doesn't, you feel frustrated, uncertain, or even threatened. This emotional reaction is very common. It happens whenever reality doesn't match your hopes. The key is to trade without being emotionally attached to the result of a single trade. If you truly understand that you don't need to know what will happen to be profitable, the fear of being wrong starts to disappear. You feel less anxious about losing and stop feeling pressure to catch every move. A professional trader focuses on following their plan, knowing that success comes from the process, not from one lucky trade. One of the hardest things to accept in trading is that anything can happen at any time. The market is always moving and changing, influenced by countless factors that are completely out of your control. From unexpected news to actions taken by large investors, any event can suddenly shift the direction of prices. Even when you've done all your analysis and everything seems to point in your favor, there's still a chance something unusual happens that changes the outcome. That doesn't mean your analysis was wrong, it just means the market doesn't follow your expectations. Many traders struggle because they think the market should reward them for their effort and time, but the market doesn't reward or punish anyone. It just moves. Your job isn't to predict the future, but to be ready for whatever comes, and to trade with discipline and trust in your system. When you accept that anything is possible, you stop needing to always be right. You can trade with more calm and confidence. Instead of fighting uncertainty, you learn to manage risk and make better, more objective decisions. Success in trading doesn't come from removing uncertainty, it comes from learning how to live with it. Many people come into trading looking for certainty, a way to win consistently. But the truth is, even when you have an edge in the market, it's not a guarantee of success. It just means you have a higher chance of one thing happening over another. For example, if your strategy says there's a 65% chance the price will go up under certain conditions, that doesn't mean you'll win every time those conditions appear. Sometimes the market will go the other way, and that's completely normal. The most common mistake is trying to find more and more confirmation, or changing your trading plan in search of absolute certainty. But when you make decisions based on things that aren't part of your tested strategy, you're adding random elements that make it harder to know if your system actually works. Confidence in your method comes from accepting that losses are part of the game, and that real success is measured over the long term, not from the result of a single trade. If you focus on recognizing the specific conditions that define your trading edge and only take trades when those conditions are present, you remove mental noise and increase your chances of success. Fear and doubt usually appear when you're not clear on what your edge is, or when you let your emotions take over. But if you understand that your edge only gives you a higher chance, not a guarantee, you can trade calmly, accept whatever result comes, and avoid the emotional roller coaster that often hurts beginner traders. The last core principle in trading is probably the hardest to accept, but also the most freeing. The results of your trades, even when you have a solid strategy, will come in a random sequence, at least in the short term. This means that even if your system has a proven win rate, you still can't know exactly when you'll win or lose. You might go through several losing trades in a row, followed by a string of winners, or the other way around. What matters is understanding that this randomness is a normal part of trading. It doesn't mean your strategy is broken, it just means that short-term results are unpredictable, even with a good system. Many beginner traders panic after a losing streak. When new traders face several losses in a row, they often panic. They start to doubt their strategy or switch to a new method. But these ups and downs are normal. Only over many trades does the math, your edge, really start to show results. Emotional freedom in trading comes when you stop obsessing over single trades and focus instead on following your plan consistently. That way, each trade becomes just another chance to apply your edge, whether it ends in a win or a loss. The goal is not to win every time, but to stay disciplined and trust the process over time. Understanding these 5 laws is just the beginning. Real change happens when you fully accept them and use them in your daily trading routine. Here are some practical tips to help you apply them. Develop a flexible mindset by accepting that the market is unpredictable and every moment is unique. Don't hold on to past patterns or results. Focus on the process, not the outcome, and judge your performance by how well you follow your plan, not by whether you made or lost money on a single trade. Stick to strict risk management by deciding in advance how much you're willing to lose on each trade, and never go beyond that limit. Keep detailed records of your trades and review your results in large groups, not one by one, to see how effective your strategy really is. Work on emotional control by learning to recognize and manage your emotions, since fear, excitement, and frustration can cloud your judgment. And trust your system. If you've tested your method and know it has an edge, keep using it with discipline even after a series of losses. Trading is an activity that tests not only your technical skills, but also your mental and emotional strength. The 5 laws shared by Mark Douglas offer a valuable guide to help you navigate the markets with more calm, clarity, and confidence. When you understand that every moment is unique, that you don't need certainty to be profitable, that anything can happen, that an edge is just a probability, not a guarantee, and that results come in random order, you'll be much better prepared to face the challenges of trading and build the consistency you're aiming for. Remember, success in the markets doesn't come from predicting the future. It comes from managing the present with discipline and accepting uncertainty as part of the game. That's the only way to trade like a real professional and build a long-term, sustainable career.